Hello friends, this is Ray Sinner, Senior FinTech Coder, and today we have an important technical topic. We will learn how to write a proper technical specification for automating a trading strategy, or simply a tech spec for a trading bot. We will discuss why it is important to write a technical specification, what exactly should be described in it and why. We will break down the process of writing a tech spec from scratch using the example of inter-exchange arbitrage strategies, and even learn where to get a technical specification if you cannot write it yourself. In conclusion, each of you will receive a simple and understandable template that you can use to automate your own trading strategy. And before we dive into the details, let's answer a simple question. What is needed to order a trading robot? In the world of financial technologies, there are smart programs that automate the trading processes on the exchange. These programs, called trading robots, monitor market conditions and execute preset instructions to make trades. For example, when a new bar event occurs, the robot starts analyzing trading signals and makes decisions accordingly. And the creation of any trading system begins with defining key trading signals for buying and selling. Gradually, various functions for monitoring, managing positions, and capital management can be integrated into this system. This means that before ordering the development of a trading robot, it is necessary to have a clearly defined trading strategy with clear rules for making decisions about trades. And these rules need to be thoroughly described. Generally, there is no universally accepted format for writing a tech spec, but based on my extensive experience, I can say that it should be a separate text document file, and here's why. Imagine a situation where a client tries to explain a rather complex trading strategy to a programmer in a messenger, such as Telegram, without any prior preparation. Oh, dear. It will take at least 100 messages of chaotic rules, screenshots, discussions, and clarifications. And the poor coder will have to scroll up and down in this chat to piece together the logic, and they will also need to consider all the rule corrections that the client will inevitably come up with as they delve into their own strategy. It's very easy to get confused here, or to implement logic that has already been changed by the author in lower messages. Even if, by some miracle, the executor manages to correctly reconstruct the logic of the trading strategy, it will take much more time than if the author sits down with a tech spec template and fills it out thoroughly and thoughtfully. It's also worth considering that the developer's time is not free, but we'll talk about the cost a little later. For now, let's just accept as true that a technical specification is an electronic document in any format that supports text formatting and attaching images. It can be a document in formats such as doc, PDF, and others. Now that you know it should be a document, are you ready to dive into the details? It's going to be intense, but I promise everything will fall into place. If you're ready, then let's begin. Introduction information. First, let's give a title to our document. Let it be called Technical Specification for the Development of the Cross-Exchange Arbitrage Automated Trading Strategy. We will also indicate the date of creation of the document, so that it will be easier to find the latest version when it is updated. Additionally, we will specify the nicknames of the client and the executor, as real names are not necessary on the internet if you do not want to enter into an official agreement. Finally, let's give a name to the trading robot, which will be called Cross-Exchange Arbitrage Trading Environment. In the second section of the technical specification, indicate the trading platform on which the trading robot will be implemented, or the technology stack that should be used to write the robot, in case you prefer a completely open and independent solution without being tied to third-party platforms. Your trading robot will necessarily use certain connections or exchanges and is intended for a specific type of trading instruments, so you should also indicate trading platform, exchange, type of trading instruments. However, do not specify that the robot should be designed for any exchange supported by the trading platform and all types of trading instruments, as the API of the exchanges have different trading capabilities, position management, data dissemination channels, and trying to cover all exchanges and trading instruments will lead to a multiple increase in code despite the fact that the trading logic will be the same for each of them. As a result, the project will be significantly more expensive and the time to implement it will increase. I develop trading solutions based on multi-asset trading platforms such as Quantower, NinjaTrader, OSEngine, as well as for other platforms in C# and .NET Stack with various connectors to exchanges and various types of trading instruments such as spot, futures, swaps. And for example, our strategy will use the Quantower trading platform, will be implemented for trading simultaneously on two exchanges Binance and Bybit, and the trading instruments will be swaps, that is, perpetual futures, since I will be shorting and I need contracts and positions. Third-party solutions. In this section, you should indicate all third-party solutions on which the logic of your trading strategy relies. Such third-party solutions include all trading indicators, scripts, parsers, libraries, machine learning, volume calculator, economic event calendars, API of third-party signal servers and solutions, extensions of the trading platform, volume analysis, and other digital products that may rely on the logic of your robot's operation. Also, in this section, you should indicate your attitude towards the use of third-party solutions for which the executor does not have the source code, for example, a virtual position manager for trading spot positions. Or clearly convey that only those solutions that will be written within the current project can be used. After all, even the code of open-source solutions is the property of the author, and not every open project can be used without regard to its license. In my case, a third-party solution used in the project will be an indicator of a divergence of prices of the same trading instrument traded on different exchanges, called direct comparator. This is my self-written indicator, so I can safely use it in my projects. Unfortunately, there is no documentation for it. However, I will include screenshots of its operation in the Tech Spec. It consists of visualizing the current and maximum price divergence of the same trading instrument placed on different exchanges in percentage terms relative to the average price of both instruments. It is a separate chart with 3 histograms. The first histogram displays the current divergence. The second histogram displays the maximum divergence value, and the third histogram displays the peak value on the current bar. The chart also has a central line at 0 value and levels offset from 0 with a given interval on both sides at equal distances, which are trading triggers. Terms. As a rule, in a trading system, there are several key important concepts or terms that describe the market state or the movement of prices. Even if you think that in the technical specification you are using a commonly accepted and simple concept, it needs to be clearly described. For each term, compose one paragraph of description. For example, according to Bill Williams, an uptrend is when all 3 alligator lines are arranged in the following order from bottom to top: blue, red, green. Another classic definition of an uptrend from Larry Williams is when each new peak is higher than the previous one, and each new bottom is higher than the previous one. When describing terms, you can use screenshots of charts. They will not hurt. In the technical specification itself, it is recommended to highlight the terms you introduce in bold to enable the executor to find them in the text immediately if doubts arise. When describing a term, you cannot refer to other sources' websites, books, forums, justifying this by the fact that it is already widely known. Everything should be described here and now, without disclaimers such as "I will explain later on Skype," which is not allowed in the technical specification. Writing all the terms in the technical specification will take no more than an hour and a half, but it will save time spent on correcting errors due to misunderstandings. Input parameters. The future trading robot will have input parameters. These are variables that affect the operation of the trading algorithm and determine its behavior in various situations. These parameters can include practically any values on which the logic of the strategy's operation relies. In my case, these values will be base account, the account of the base trading instrument; quote account, the account of the quoting trading instrument; base symbol, the base trading instrument; quote symbol, the quoting trading instrument; base step, the base step of price divergence between the base and quoting trading instruments in percentage terms of the average cost of both assets; step factor, the multiplication factor for the distance of each subsequent step of price divergence; volume, the amount of order volume measured in the quoting asset for both trading instruments on both exchanges. For a long position, this will be the amount of USDT for which a certain volume of BTC is purchased in the BTC USDT trading instrument at the current price. For a short position, this will be the amount of USDT corresponding to a certain volume of BTC sold in the BTC USDT trading instrument at the current price. Description of the trading strategy. On the next step, describe the general idea of your trading strategy. Here you can indicate on which exchanges and trading instruments the robot will trade, whether it trades with a trend, how it is determined, and on which time frame. If trading with a trend, describe how the entry occurs, on a pullback, on a breakout of a level, etc. Basically, there are only 3 trading strategies on financial markets: following the current trend, returning to the average value, and arbitrage. Your trading idea should be one of these 3 strategies. It is necessary to explain how trades will be opened, at the market, after confirmation of a breakout/pullback, or at a more suitable price. In my case, the trading strategy has the following description. The robot's strategy is spatial arbitrage, meaning the robot tracks the increase in the spread between identical trading instruments, which have the type of swap or perpetual futures, on 2 exchanges, Binance and Bybit, and when the percentage price divergence reaches the value of the next trigger, it places 2 orders on both exchanges with the same predetermined volume but opposite in direction. Their directions depend on the type of trading signal for selling or buying the spread. Trading signals. The next section of the technical specification, the most important one, is trading signals. Here, you should describe all trading signals that exist in your strategy. These can be signals for buying, for selling, for increasing the position volume, for partially closing the position, for closing the position, and other types of signals. Trading signals are an important part of our robot, which must accurately follow signals for buying or selling depending on certain conditions. In the technical specification, we must describe the conditions for generating a buy signal and separately sell signals, even if they are simply mirrored, as well as the parameters that affect this condition. Formalization of parameters. To set up a buy signal, it is necessary to specify the parameters affecting the generation of trading signals, for example, indicator parameters, which may include type of moving average, period of moving average, other parameters. In my case, none of the indicator parameters affect the logic of generating the signal, as the settings of the base and quoting trading instruments only determine the compared instruments. The step back of the trigger from the 0 point and its increase factor change the magnitude by which the spread value should change to form a signal. However, most often, indicators working with the analysis of bar value sequences have such parameters, and they need to be specified, for example, the EMA indicator type of moving average, SMA, and period, 20. My example of a buy signal. A buy signal occurs immediately when the value of the current spread of the first histogram on the direct comparator indicator crosses the value of any trigger with a positive value from bottom to top, and provided that there are no open positions on this trigger, a sell signal for the spread is formed. This means that a market order to sell is placed on the exchange of the base trading instrument. As this asset is overvalued, a short position is opened, and a market order to buy is placed on the exchange of the quoting trading instrument. As this asset is undervalued, a long position is opened. My example of a sell signal. A sell signal occurs immediately when the value of the current spread of the first histogram on the direct comparator indicator crosses the value of any trigger with a negative value from top to bottom, and provided that there are no open positions on this trigger, a sell signal for the spread is formed. This means that a market order to buy is placed on the exchange of the base trading instrument. As this asset is undervalued, a long position is opened, and a market order to sell is placed on the exchange of the quoting trading instrument. As this asset is overvalued, a short position is opened. My signal to close all positions. A signal to close all positions or the entire accumulated trading volume for both trading instruments on both exchanges, regardless of the direction of their positions, occurs immediately when the value of the current spread of the first histogram on the direct comparator indicator crosses the zero value, regardless of which side the intersection is from top to bottom or from bottom to top. Closing positions also occurs with market orders. Please note that it is necessary to clarify the phrase crosses the value. It is not as simple as it seems. The signal may appear immediately at the moment of crossing the average, or you can wait until the candle not only breaks through the level of the average but also closes above it. If we use a moving average with the type SMA and a period of 20, a buy signal will be generated when the price crosses this average from above. If the candle breaks through the level of the average but does not close above it, the signal will be ignored. For debugging and visual verification of trading signals, the trading robot should contain an indicator based on the strategy and place markers/objects on the chart at the moment the signal appears, if necessary. This will not only allow debugging on historical data but also visually observe the signals on the chart. It may be even more correct to first create an indicator that marks buy/sell signals on the chart with arrows. This will simplify writing the robot because it is easier to create and debug two separate programs than one complex one. Let the robot only trade, and the indicator only draws. In this case, the robot's code will be free from unnecessary functionality. Overall, trading signals should be simple and strictly described using algorithms. For example, well-known and popular patterns such as head and shoulders and Gartley butterfly are found by traders on the chart literally by guesswork, based on what they believe is a certain cluster of candles that forms the pattern. However, in algorithmic trading, there is no guesswork. Any relationship between candles should be described with intolerances, both in terms of the number of candles in the pattern and the spread of pattern points relative to each other and in percentage terms relative to the change in asset price. Only if all values of the candle interval are within the established framework of pattern value relationships can the algorithm say that there is a pattern on the chart at this moment. Additionally, it is important to precisely define concepts such as trend, level, breakout, pullback, and intersection, which are related to working with ticks, bars, and closing prices, and incorporate these definitions into the technical specification section dedicated to terms. Thus, trading signals should be simple and strictly described using algorithms. Writing a robot should be based on a clear description of parameters and conditions for generating a buy or sell signal. Visual verification of signals can help in debugging and optimizing the trading system. Lifetime of signals, orders, positions. The second important part of the trading strategy is the expiration of the trading signal, cancellation of pending orders, and closing of open positions. Trading signals can be cancelled due to a time limit or the occurrence of certain events. In addition to this, each trading signal should be associated with the type of order it generates and the lifetime of that order. It is also necessary to describe the events under which pending orders are cancelled and open positions are closed. In the technical specification, you can add additional capabilities for deleting orders and closing positions. By a closing trading signal. Upon reaching a specified profit or loss on the open position. When the price moves a specified distance from the current level of the open pending order, essentially meaning the moment has been missed. At a specified time. After a specified number of bars. At the end of a specified time interval. Upon the appearance of a signal in the opposite direction. When a favorable situation/pattern disappears. My example of this point looks like this. For all signals, orders are placed at the market. These are market orders. They have immediate execution at the nearest available prices in the order book. The strategy does not have pending orders, which means that placed orders cannot be cancelled. Positions are closed both in normal mode when a signal to close all positions arrives and in emergency mode when trading cannot be conducted on one of the exchanges. The fact is that we simultaneously send two orders to both exchanges with opposite directions, and a non-standard situation may arise on one of the exchanges with the cancellation of the order and refusal to open a position. In such a case, we close the position on the exchange where it opened, as this disrupts the logic of the robot's paired trading. Management of open positions and pending orders. If your trading strategy uses closing levels of stop loss and take profit, specify the algorithm for calculating them. For flexible shifting of these levels, describe the conditions and algorithm of trailing. Stop loss and take profit levels can be changed both when a new candle opens and with each tick. If your strategy allows for increasing the position size with additional volume under certain circumstances after executing the initial order set by the opening position signal, and outside the trading signal to increase the position volume, these circumstances also need to be described in the section on managing open positions. My example, despite the fact that this has already been described in the section on trading signals, I will repeat that the direct comparator indicator places an unlimited number of triggers at a certain distance, and on each new trigger crossed by the value of the first histogram of the current spread, positions should increase their volume by the value from the volume setting of this robot. Calculation of order volume for opening a position. Some clients immediately add functions to control the position size. However, at the initial stage, it is recommended not to include money management algorithms in the robot for calculating the position volume, as additional parameters during robot optimization can lead to adaptation to a specific section of history. If you are creating the first version of the robot according to your trading system, it is better to test and optimize it with a constant volume. Only after test trading on historical data and real trading for several months, when you see the strengths and weaknesses of your algorithm, can you start thinking about capital management. Here are some approaches to calculating the volume when opening a position. Fixed volume, regardless of profit or losses. Volume depends on the size of the balance or equity. Based on the obtained profits/losses. Based on the results of the last end trades, various versions of martingale and anti-martingale. Depending on the percentage of risk when placing a protective stop-loss order. Other approaches based on risk calculation, such as Vince's method. In any case, before adding the order volume calculation to the trading robot, you need to be sure that your trading system has an advantage over random trading. Otherwise, you will simply deceive yourself. A losing system cannot be turned into a profitable one solely through capital management. In my case, this point will be as follows. All orders are placed with a volume equal to the value of the volume setting of this robot. Additional actions of the trading strategy. An automated trading strategy is, first and foremost, a program, and it has access to non-trading actions as well, such as sending trading signals to Telegram bots or web representation for monitoring the state via an internet browser and control panel. There is no need to list them here, as they can be any non-trading functionality necessary for you as the client. My strategy does not require additional actions. Handling trading errors and environmental state. A trading robot is an autonomous program that operates 24 hours a day. Therefore, it is necessary to provide monitoring and checking of its operation. The black box of your advisor will be the log file. In general, it is recommended to record the appearance of signals, patterns, and setups, the current market price, and the parameters of the trading request before sending the order for execution. In case of unsuccessful execution of the trading request, its results should be logged. Analyzing the response codes of the trading server will help understand the cause of the trading error and correct it. Describe in the technical specification. All situations in which entries are made in the log. Parameters that need to be reflected in each case. The desired format of the entry, for example, time, numerical data, separators, etc. Detailed logs of trading orders and the results of their execution will allow you to quickly identify trading errors and save money. An important point often overlooked by novice algorithmic traders is the situation of terminal restart, loss of internet, or connection to the trading server. In such cases, it would not hurt to think about feedback with the robot through messengers or email. In my case, the robot records in a CSV file data on found spread divergences and the time of existence of such a divergence from the moment of the trading signal to buy to the moment of the trading signal to close positions in milliseconds. To each such signal adds data on orders placed on exchanges according to the current signal, namely the time of sending the order, the name of the exchange, the name of the trading instrument, the volume of the order, the current price of the asset at the time of sending the order, the direction of the order, the time of execution of the order, the volume-weighted average price at which the order was executed. Since the robot is based on the Quantower trading platform, the platform automatically logs the most common environmental errors, and the built-in logs of errors will be sufficient for me. Stages of developing and payment. Break down the development process and payment into stages. As you have understood, developing a full-fledged automated trading system is a long and painstaking process that can take several days, even if it's just a crossover of two moving averages with a volume filter. Therefore, to save your money and the developer's time, it is customary to break the creation and improvement of the trading system into several stages, after the completion of each of which the client can refuse to continue the development process. Here's an example of stages. Implementation of the general trading logic of the strategy so that it can be tested in a strategy tester, far from real trading, but all the main trading metrics should already be available through testing on historical data. Error handling identified in the main logic of the strategy. Adaptation of the strategy to real trading on selected exchanges. Adding journaling, a database for storing the trading state of the strategy, registration of orders, trades, and open positions. Handling errors in the trading environment. Adding error logging in a log database. Error handling identified through journaling. Adding capital management logic. General testing. I will use these stages in my technical specification. Before each stage, it is necessary to preliminarily agree on the deadlines for completion, and preferably make an advance payment for the agreed time before the start of each stage. Programmers do not like to work for free, and 90% of clients do not like to pay for what turns out to be unprofitable in the tester and ignore the developer after the first stage of testing the logic in the backtester when they realize that their strategy is not the holy grail. It is worth understanding that it is quite difficult to guess the required time for each stage, and there may be an increase in cost during the work. Unfortunately, this happens, and if this is not acceptable, it is better to discuss this with the developer in advance. Perhaps he will take these risks upon himself and fix the cost, or perhaps he will ask for daily payment, regardless of the amount of work, or possibly refuse the project as he may consider the client non-payable, which may lead to problems with payment in the future. You are a great person if you have read all the points that should be displayed in your technical specification, but now I would like to draw your attention to some important points. Now let's answer the question, where to get a technical specification if you cannot write it yourself. A poorly composed technical specification or its actual absence most often indicates that the rules of the trading system have not been formulated. They simply do not exist. What the client calls a trading system in this case is actually just an idea. It is impossible to start working under such conditions because very soon, in the process of writing the code, uncovered nuances or the absence of an algorithm for unforeseen situations on the market will become apparent. In this case, the programmer starts to come up with options instead of the client. As a result, the executor may, at their own risk, complete the work and provide the trading robot to the client, but this is accompanied by a loss of time on discussing each new question. In addition, the likelihood of a negative scenario increases if, upon acceptance and verification of the completed work, the client suddenly discovers that the deals are not being made as he expected. After all, he simply could not describe everything correctly. And of course, in this case, the client will blame the executor for violating certain points of the technical specification and incorrect programming of the robot. Disputes in such cases are resolved based on the technical specification. When considering disputes, correspondence between the parties is not taken into account. When considering the subject of the dispute, the basis for making a decision is only the technical specification. In life, there is also such a variant. You have strict trading rules, but for some reason, you cannot independently compose a technical specification. For example, you do not know how to correctly describe certain things, or you need the help of a specialist in mathematics, neural networks, machine learning, programming, etc. In this case, you can order the creation of a technical specification. Such work is also paid for based on the time spent on consultations and preparing the technical specification. An experienced developer of trading systems will help you correctly formulate the rules of your strategy so that they are understandable to another programmer or to you, if it is the same person. At the same time, you must be able to work with charts, indicators, and graphical objects to show the settings of your trading signals on screenshots. The programmer will understand your trading system and help write a description of the trading algorithm if possible. If you cannot independently formulate certain concepts, for example, impulse or bounce from level, they can give you ready-made ideas based on their experience. As a rule, any situation on the market can be logically and then programmatically described by some simple model with variational parameters. And this change can be expressed by a certain parameter, which you then optimize in your robot. There are no perfect patterns because, on the one hand, the market never repeats itself, and on the other hand, similar situations can always be found in history. The result of your joint work should be a ready-made technical specification for ordering a trading robot according to your strategy. However, the programmer is not all-powerful. What can't the programmer do for you? It may happen that the robot written according to your system will show a loss during testing, although when manually testing, you were firmly convinced that the strategy brings profit. As a rule, the reason for such behavior lies in the fact that the client had the opportunity to manually check their system only for a short period of time. At the same time, the tester allows you to get the results of trading on any available historical interval. What to do in this case? The programmer cannot turn a losing strategy into a profitable one, but they can give you several ideas for improving the quality of entries. For example, add several trend filters, volume, etc., which will filter out bad signals. Perhaps your strategy will work with other parameters, more optimal for the current state of the market. Perform optimization and study how the found optimal values change depending on the year, volatility, and other factors. This will help you identify weak points or limitations in your system, but you will have to do this yourself. The programmer is just a code writer, not a trading systems expert analyst. And the last but not least, programmers' mistakes. It is almost impossible to write a program without errors. They will still be there. These can be both coding errors, when the code is written incorrectly according to the correct algorithm, and logical errors, yours. In both cases, you will have to look for them yourself, as it is unlikely that anyone can do this for you. Include in the technical specification the requirement for mandatory processing of the results of each important operation and output of error codes to the log. In a separate section of the Tech Spec, you can detail what exactly is an important operation, sending a trading request, calculating the stop-loss price, etc. We recommend using predefined macro substitutions in these messages. This will allow you to quickly find the cause and location of incorrect operation of your robot. Using these three simple rules will make it easier for you to analyze the situation and communicate with the executor. A few words about the cost of development. Considering that a month of work for a programmer, and even more so a fintech coder, costs at least $4,000, believe me, the cost of developing a full-featured trading strategy rarely goes below $1,000. Although a version that works in a tester may literally cost you $200 to $300. Of course, you can find a hungry coder on freelancing who is willing to agree to anything for $200, but know that I guarantee you, you will not get a trading strategy that can be safely put into real trading. And the coder will not waste their time on you for those $200, even if they have taken on these obligations, and will disappear halfway through, as soon as they receive payment for their services from you. Know that cooperation must be mutually beneficial. This is one of the main conditions for a profitable automated strategy. Congratulations, now you have a new skill, composing a technical specification for automating a trading strategy. If you need a robot for your strategy, write to me. All links are below the video. Thank you all.